Gold is flashing a warning sign right now. On Wednesday, August 19, 2026, XAU/USD has bounced to around $4,370, but if you look at the daily chart, the rebound is already losing steam. The metal has now spent 5 sessions pinned below a descending trend line. That is not a bullish breakout. It is a market stuck under a ceiling. The bounce itself is not the problem, the lack of follow-through is. The key number traders are watching is $4,432. Without a decisive daily close above that level, this bounce could be nothing more than a pause before the next leg lower. The most important recent signal came from the $4,440 to $4,450 zone. Gold pushed into it late last week and was firmly rejected. Since then, every rally has struggled. Monday saw gold rise 0.54% to $4,400.26, but it still could not clear the trend line. By today, the price has slipped back towards $4,370. Traders who bought the dip are now taking profits into resistance. The reason is partly macro. The US dollar has softened, which normally supports gold, but a steady producer price index print has removed some of the inflation fear premium. When producer prices do not surprise to the upside, gold loses one of its main arguments for rapid gains. Right now, the market is sitting between two critical zones. On the downside, the $4,370 to $4,382 support cluster is the line in the sand. On the upside, $4,432 is the breakout trigger. This range is tight enough to trap both breakout buyers and breakdown sellers. A move below 4,370 would target the 4,330 zone mentioned in intraday trading. A close above 4,432, however, would signal that the rejection near 4,450 was a false breakdown and bring the highs back into focus. For retail traders, this is not the time to chase strength. The near-term path depends on how gold handles these levels over the next 24 to 48 hours. The descending trend line is still the dominant feature, and momentum indicators are not confirming new highs. That suggests the safer probability is a continued grind lower, especially if the dollar stabilizes or US yields tick higher. A break below 4,370 would expose lower support quickly. But if buyers defend the 4,370 to 4,382 support and push through 4,432 on strong volume, the psychology shifts quickly. Watch the daily close, not the intraday spike, because gold has a habit of false breaks above trend lines when momentum is fading. So the key takeaway is simple. Gold is bouncing, but the bounce is not convincing. The 4,370 level may hold, but it is not a buying signal by itself. The trend line, the rejection at 4,440 to 4,450, and the fading upside momentum all point to patience. Until gold closes above 4,432, treat rallies with caution. If you are bullish, you want to see a decisive break with volume. If you are bearish, the support cluster at 4,370 is your early warning. Either way, today's price action is a reminder that a bounce and a reversal are two very different things. That is the level to watch before you commit capital. If that level fails, the bullish case weakens materially.